In today's video, I will test the best YouTube trading strategy created by Quantum Trading Strategy with the goal to find out its true win rate after 100 trades. This strategy has multiple ways of using it. In this video, I'm only going to be testing 2 of them. The creator mentioned that this strategy works perfectly well on the price of a Bitcoin USD on a 15-minute time frame. So the main indicator this strategy is based on is called Divergence for Many Indicators V4 by Lonesometheblue. This tool is very popular, it's got over 13k likes. It basically searches for divergences on chosen indicators such as RSI, MACD, MACD histogram, stochastic, CCI, unbalanced volume, VW MACD and checking money flow. It checks following divergences for 16 pivot points, that is in the last 100 bars for each indicator. For positive divergence, it first checks if closing price is higher than the last closing price and the indicator value is higher than previous value. For negative divergence though, it first checks if closing price is lower than the last closing price and indicator value is lower than previous value. Before we start using this indicator, we need to make some adjustments. So let's first change the colors for these positive and negative divergences. And in the star section, let's remove the lines. Okay, so if there is a positive divergence found in the price action, this is considered as a buy signal. And if the indicator spotted a negative divergence, this is also a sell signal. And just by looking at these signals, we can tell that the indicator is not really accurate. But don't worry, we're not going to be using this indicator on its own. So for our first method of using divergences, we need to add another tool to our chart that's called STC. STC indicator a better MACD by Sean KM. Let's access its settings and change the length from 12 to 19 and the fast length from 26 to 27. So here are the conditions for entering a long trade. First, the indicator has to find a positive divergence. By the way, it doesn't really matter how many indicators are shown on a label. And second, the STC indicator has to be green color and the line needs to be pointing upwards. By the way, if the STC hasn't caught up by the time the indicator issued a buy signal, we can wait another 2 candlesticks for it to catch up. A buy order will be placed at the close of our trigger candlestick. The stop loss will be set at the recent swing low. The creator of the strategy hasn't mentioned anything about the profit target, so we're just going to place it at 1.5 times the risk. Here's another example. So we see the indicator found a positive divergence on 2 indicators, but the STC line is still red. 2 candlesticks later, we have the indicator caught up, and now we can place a buy order. Alright, now let's understand the rules for short trades. First, the indicator has to find a negative divergence. Second, the STC must be red and the line needs to be pointing downwards. And again, if the STC hasn't caught up by the time the indicator found a negative divergence, we can allow another 2 candlesticks for it to catch up. Our stop loss will be set at the recent swing high. And we're going to be targeting 1.5 times the risk. Here's another example. So here we see the indicator found a negative divergence, but the STC indicator hasn't caught up yet. So we waited another 2 candlesticks and the indicator caught up. Now we can see that these entries are not valid because the STC simply does not confirm them. Okay, now let's do our first backtesting to see how well this strategy performs in different market conditions. So the backtesting is finished, and as we can see, we started with $1,000 and we were risking 2% of our account in order to make 3. The win rate for this strategy is 48%, and we increased our account size by 44.52%. The profit factor is 1.38 and we had 7 consecutive wins against 8 consecutive losses. Also notice the maximum drawdown was 21.26%. So based on these numbers, we can tell that the strategy is making money. However, the drawdown is not acceptable at all. The strategy is simply not safe enough for you to go ahead and trade with it on a live market. In terms of maximum drawdown, the strategy should not give you more than 10%. Okay, now let's move on to our second method. For this method, we need to remove the STC and add an exponential moving average to the chart. Also, let's change its length from 9 to 200 and make the indicator a bit more visible. And the goal behind this strategy is simple. You basically want to be entering a trade when the price action is making a pullback into 200 EMA. Okay, let's understand the rules for entering a long trade. First, the price action must be in an uptrend, which means it's moving above the 200 EMA. Second, we need to have a pullback into the moving average. Third, the indicator has to find a positive divergence. Also, the trigger candlestick must be closed above the 200 EMA. Our stop loss will be set at the recent lowest price or at the closest level of support. And for this strategy, we're also going to be targeting 1.5 times the risk. Okay, let me give you a couple more examples. So here we see the price was in an uptrend and it made a pullback. The indicator spotted a positive divergence, so we can confidently enter the trade. Right after this trade, we had another signal. By the way, the price action doesn't necessarily need to touch the moving average. It's enough for it to get really close to it. Alright, here we see we have another signal. Okay, now let's understand the short positions. First, the price action must be in a downtrend. Second, it has to pull back into 200 EMA. By the way, I forgot to mention the line must be pointing in the direction of the trend. So for short trades, it has to be pointing downwards. Third, the indicator has to find a negative divergence. Once we have these rules met, we can place a sell order at the close of our trigger candlestick. Our stop loss will be set at the recent swing high or at the closest level of resistance, and we're going to be targeting 1.5 times the risk. Okay, here's another example. We see the price action keeps moving downwards and the indicator spotted a bearish divergence. Okay, I hope you have understood the rules. Now let's see if this strategy is any better than the first one. Okay, the backtesting is finished and here are the results. So the win rate for the strategy is 60% and we increased our account size by 162.59%. The profit factor is 2.25 and we had 7 consecutive wins against 5 consecutive losses. The maximum drawdown for the strategy is 9.61%. So these numbers basically tell us that this strategy is less risky. I definitely recommend it. Go ahead and backtest it and forward test it on different markets and different time frames as well. If you want to increase the win rate for the strategy even more, I highly recommend you add a good volume indicator to the chart. You can screenshot my favorite volume indicators and then try them one by one. Also, don't forget to do your proper backtesting. Okay traders, I hope you enjoyed this video. Make sure you click the like button as it really helps with the channel. By the way, if you want to see my best strategy on the channel, check out this video right here.